Hello and welcome to this lecture. Today we will be talking about the accounting cycle and all the steps involved in it. To start, let us look at what the accounting cycle is according to Tarver in 2019. The accounting cycle is a basic 8-step process for completing a company's bookkeeping tasks. It provides a clear guide for the recording, analysis, and final reporting of a business financial activities. Based on this definition by Tarver in 2019, the accounting cycle is basically a series of steps that a business entity follows in order to record, analyze, and report its financial activities. This process occurs over a specific amount of time known as the accounting or reporting period. The time set for an accounting cycle can be on a monthly, quarterly, or yearly basis, or even longer, depending on the nature and needs of the company. Since it is a cycle, once the reporting period is over, the cycle begins again in the following period, and so on. Now you may ask, why is the accounting cycle important? Well, first of all, it provides a clear and systematic guide to a business entity in doing its accounting tasks. Secondly, it helps to ensure consistency, accuracy, and efficiency in the analysis of the business financial performance. Of course, when analysis is consistent, accurate, and efficient, the business will be able to make well-informed and effective decisions. Now that we know the definition and importance of the accounting cycle, let us go through those 8 basic steps in the accounting cycle that I have mentioned earlier. Although, just a disclaimer for you, in actual practice, businesses may have more or less than 8 steps. However, what we will discuss today are overall the fundamentals in the process. And the first step to this process is to identify and analyze transactions. Now, in identifying and analyzing transactions, we must first know what transactions should actually be recorded. These are business transactions. Business transactions are events where there is an exchange of values, a value received and a value parted with. In other words, these are economic events that affect the financial position of the business. I want to emphasize that these transactions should only pertain to the business entity, otherwise they are not recorded. The bookkeeper must then identify which accounts in the accounting equation are affected and for how much. For this step, source documents are mostly the basis of recording. Source documents are business documents that evidence an economic transaction, for example, official receipts, sales invoices, and bank statements. After transactions have been determined and examined, they are then recorded in the general journal, which is our step number 2. The general journal, or simply journal, is called the book of original entry in which transactions are recorded in chronological order. The process of recording in the journal is called journalizing. In journalizing, entities make use of the double entry bookkeeping system. Here, each transaction has debit and credit entries which must equal each other. There may be more than 2 accounts debited and credited. Regardless, the debits and credits must balance. The question now is, when should a transaction be recorded? Well, it depends on whether the entity follows accrual accounting or the cash accounting method. The first one, accrual accounting, requires the matching of revenues with expenses, so both must be booked at the time of sale. Transaction is basically recorded when revenues are earned and when expenses are incurred. Entities mostly use this method as it is the theoretically correct one. On the other hand, cash accounting requires transactions to be recorded when cash is either received or paid. It disregards the time when revenues are earned and when expenses are incurred. After recording in the journal, the entries are then posted to the general ledger, and that is step number 3. The general ledger is the book of final entry which contains a collection of accounts that shows the changes made to each account as a result of past transactions and their current balances, according to accountingverse.com. The general ledger, in other words, is a summary of the transactions that show the financial status of each account. The process of recording from the journal to the ledger is called posting, and this process actually happens continuously throughout the accounting period. However, the frequency of posting to the ledger depends on the entity. Now, after posting to the ledger, we now prepare the unadjusted trial balance, which is step number 4. In this step, the total balances per account from the general ledger is arranged into a report called the trial balance. The trial balance is a summary of all accounts whether they have debit or credit balances, which are derived from the general ledger. What is the purpose of a trial balance? Well, the purpose of a trial balance is to test the equality of the debits and credits. The sum of all debit balances should equal to the sum of all credit balances. Trial balances are also made to see if there are errors, and if errors are found, these are corrected before proceeding to the following step. And that following step is to record adjusting entries. This step is done in the end of the accounting or reporting period. Especially since most entities use the accrual accounting, accruals and deferrals must be adjusted. Examples are accrued rental income or prepayments from customers. There may be revenues that have been earned or expenses that have been incurred that haven't yet been accounted for. The adjusting process is then basically matching revenues with expenses. Moreover, adjusting entries are prepared to update the accounts before they are summarized in the financial statements. These entries are recorded in the journal and posted to the ledger as well. To again ensure that the debits and credits are balanced, a worksheet may be created. If discrepancies are found, corrective adjustments must be made. This is besides the adjustments to be made in relation to accruals and deferrals. Now, after doing that, we go on to step number 6, which is to prepare the adjusted trial balance. Another trial balance is made after the adjusting process. Hence, it is an adjusted trial balance, while previously in step 4, we called it unadjusted trial balance. Again, the purpose of this is to ensure that debit and credit totals are equal after adjusting entries have been made and right before financial statements are prepared. And speaking of financial statements, that is our step number 7, prepare financial statements. After equality is ensured, financial statements can now be prepared based on the adjusted trial balance. Specifically, most entities prepare the following 3 important financial statements at the end of the accounting period. The first one is income statement, or also called the statement of comprehensive income, which reports the financial performance of the business. Second is the balance sheet, which is also called the statement of financial position, and it reports the financial standing of the business in terms of assets, liabilities, and equity. Last is the cash flow statement, which reports the inflows and outflows of the cash in the business. Actually, there are other financial statements that can be prepared. What financial statements must be prepared all depends on the needs of the business as well as the stakeholders who make use of these statements to make decisions. And for that, we go on to the very last step of the accounting cycle, which is to close the books. The accounting cycle ends by closing the books at the end of the reporting period. Only temporary accounts are closed in this step. Temporary or nominal accounts include income, expenses, and withdrawal accounts, which are measured periodically and are not carried over to the next accounting period. In contrast, permanent or real accounts such as receivables and obligations, which are found in the balance sheet and determine the financial position of the business, are not closed. According to CFI Education Incorporated, the revenue and expense accounts are closed and zeroed out for the next accounting cycle. Closing entries are recorded in the journal and posted to the ledger to close the temporary accounts. The entity can then prepare a post-closing trial balance, which represents the balances of assets, liabilities, and equity, or the permanent accounts only. Since temporary accounts have already been closed or zeroed out, they are no longer part of the post-closing trial balance. The balances on the post-closing are transferred to the next financial year as an opening balance. With that, the accounting cycle ends, and in the next reporting period, the process goes from step 1 to step 8 once again, and so on. That is the accounting cycle. To conclude, there are 8 basic steps in the accounting cycle. In real life, the steps vary. There may be more or less than 8 steps because they depend upon the nature and the needs of the businesses. For example, others do the optional step of reversing entries at the beginning of the accounting period. Nevertheless, what matters is the entity has clear and systematic accounting procedures so that recording, analyzing, and reporting are consistent, accurate, and efficient. That's it for the lecture. Thank you for listening.